Ladies and gentlemen, good day and welcome to the CreditAccess Grameen Limited Q4FY23 earnings conference call hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidesh Jain from Investec. Thank you, and over to you, sir.
Thank you, Darwin. Welcome to the Q4 FY23 earnings conference call of CreditAccess Grameen Limited. To discuss the financial performance of CreditAccess Grameen and to address your queries, we have with us Mr. Uday Kumar Hebbar, MD and CEO of CreditAccess Grameen, Mr. Ganesh Narayanan, Mr. Balakrishnan Kamath, CFO, and Mr. Nilesh Talvi, SVP and Head Investor Relations. I would now like to hand over the call to Mr. Uday Kumar for his opening comments. Over to you, sir.
Thank you, Nilesh. Good evening to everyone. We thank you all for joining this conference call to discuss our fourth quarter and FY23 financial performance. It's comforting to acknowledge that we have once again achieved our annual performance guidance. We closed the FY23 by recording 26.7 YoY growth in AUM to rupees 21,031 crores, serving 46.2 lakh customers. It is a historic year for us as we crossed rupees 20,000 crores AUM, becoming the first pure-play microfinance institution to achieve this feat. We are the only NBFC to feature in the top 5 of the Fortune India Next 500 list, given our revenue profile. We recorded the highest ever quarterly disbursement of 7,171 crore, supported by robust customer additions. We need to note that during FY21 and FY22, renewals and new business originations happened in the second half due to COVID-19. Hence, the renewals are also stacked in the second half of this financial year. Further, we have laid emphasis on new customer additions and increasing business from 500 plus branches which were opened over recent years to improve productivity. As you are aware, the CA Grameen MMFL merger was approved by the National Company Law Tribunal bench of Bengaluru on 15 February 2023. Going forward, we shall be reporting all the operational and financial parameters on a consolidated basis only. Our customer base grew 11.5% YoY as we added over 12.2 lakh customers during FY23 and 8.3 QoQ as we added nearly 5.5 lakh customers in Q4 FY23, respectively towards our pursuit of creating women entrepreneurs. Around 46% of our new customers added came outside the top 3 states, which have been a trend for last few quarters, demonstrating the result of our diversification efforts. As we exclude the 3.4 lakh customers written off during FY23, 63% of which came from MMFL book, the customer base growth would have been 20.4%. We added 167 branches during FY23, majority in newer geography, leading to a total branch network of 1,786 spread across 352 districts in 14 states. We are gaining healthy traction in newer geographies where we foresee gaining substantial market share in the coming years. Our collection efficiency continues to remain normalized, clocking at 98.2 excluding arrears and efficiency level similar to the last quarter. Our best-in-class asset quality is driven by loyal customer base and our execution strength, which is a testament of sticking to basics by following the classical JLG model. GNPA 60 plus DPD reduced to 1.21% in March 2023 from 1.71% in December 2022, while PAR 90 reduced from 1.34% in December 2022 to 0.96% in March 2023. The net NPA fell to 0.42% in March 2023 from 0.59% in December 2022. Overall ECL stood at 1.78% at the end of Q4 FY23, which is again higher than our GNPA. Our NIMs improved further from 11.9% in Q3 FY23 to 12.2% in Q4 FY23, one of the most competitive in the microfinance industry. They are expected to remain the range of 12.2 to 12.2% going forward. As guided, our major drawdowns in the last quarter came from domestic sources, helping stabilize our marginal and average cost of borrowing. Our marginal and average cost of borrowing for Q4 FY23 stood at 9.4% and 9.5% respectively. We would like to put on record that despite repo rate rising by 250 bps in the last 12 months, our judicious mix of utilizing various funding avenues has led to the average cost of borrowing increase of merely 60 bps to 9.5% compared to 8.9% at the end of the March 2022. We have always strived to keep our interest rate to our customers one of the lowest in the industry, which is a factor of efficiencies built throughout the system. We would like to inform you that ICRA has also upgraded our credit rating to AA- stable outlook from A+, positive outlook given our asset quality and earning profile. We are now rated by both ICRA and India Ratings with AA- stable outlook, being the highest standalone rating in the microfinance industry. Further, our inherent ESG adherence and strong compliance standards helped us to secure ESG ratings from Analysts and S&P Global. Our ESG rating fares better than many leading BFSI companies in India across the world. We have also obtained second-party opinion from Analysts on the social bond and loan framework in April 2023. These developments will further help us to access ESG-linked funds from global lending institutions and further strengthen our liability profile going forward. For the Q4 FY23, the NII grew by 32.7% YOY to rupees 690 crores, while the cost-to-income ratio stood healthy at 30.2%, which is 360 bps lower YOY. PPOP grew by 36.3% YOY to rupees 503 crores, demonstrating a strong operational profitability trend. For FY23, the NII stood at 2,234 crores, registering a 35.1% growth, while PPOP grew by 39.8% to rupees 1,506 crores, indicating a strong operating profitability trend. The credit cost in Q4 FY23 stood at rupees 105 crore, including rupees 14 crore management overlay on the legacy book of NFL amounting to rupees 131 crore or 0.6% of total area. The credit cost was partially offset by rupees 16.8 crore of bad debt recovery during the fourth quarter. Therefore, net credit cost for FY23 stood at 2.1%. Our PAT grew by 86.4% YOY and 37.5% QOQ to rupees 297 crore during Q4 FY23, resulting in ROA and ROE of 5.5% and 24% respectively. For FY23, we delivered a PAT of rupees 826 crore, leading to ROA of 4.2% and ROE of 18%, meeting our annual performance guidance. We are further maintaining a comfortable capital adequacy ratio of 23.6% at the end of March 23. Our expansive presence across India, differentiated operating model, customized product offerings, highly stable technology stack, experienced management team, diversified liability profile, and strong balance sheet place us at the forefront to establish ourselves as the preferred financial partner to millions of underserved low-income households. Our business model, based on the premise of suitable process, product, and pricing, along with suitable servicing, has always rewarded us. Assuming a stable operating environment, we look forward to achieve loan portfolio growth of 24 to 25% in FY24. Given our stronghold on the borrowing cost, we foresee maintaining NIMs in the range of 12 to 12.2% with positive income ratio between 35 to 36%. We are anticipating a credit cost of 1.6 to 1.8%. Overall, we aim to achieve a ROA of 4.7 to 4.9% and an ROE of 20 to 21% in FY24. So with this, I would like to open the forum for question and answers. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations on a great set of numbers, sir.
Thank you.
A few questions, 2 to 3 questions from my side. To start with, first of all, your view on both sides of margin. I mean, on the yield side, I mean, any more increase can be seen in the new disbursement rate, which currently is 21.9%, and in turn, any more scope in the portfolio yield, which is at 19.7%. And second part is, you already indicated marginal cost of borrowing, so it's down to 9.4% from 10.2% in December quarter. What are the key reasons? Do you think it will stabilize at this level or can improve any further from these levels? So this is the first question on the margin side.
Sure. Maybe I'll answer the margin first. The change is basically we borrowed more of a domestic borrowings in the Q4, whereas in Q3 we borrowed a bit of international borrowings plus NCD we raised. Therefore, marginal costing was higher in the Q3, whereas cost is lower in the Q4. Majority of our borrowing was domestic borrowing in Q4. Therefore, the cost has come down. Therefore, the average cost of borrowing also has come down. So therefore, there's a difference. That's all. So on the yield and NIM, so yield might go different a little bit more than the Q4, but Q4 may be a bit of benchmark with maybe 20-30 bits higher possibility for the next financial year. In the meantime, NIM would remain in the same range of 12.2%. So because there's a little leverage impact will be there, therefore we presume that it will remain around that range.
Okay, and on this marginal cost of borrowing, do you think we'll stabilize at these levels if there are no more or hardly any repo rate hike going forward?
So it might go up a bit actually. Our estimation it may still go up by about 20-30 bits because some of the MCLR increase of the bank who have not yet transferred to us because we have lot of borrowings at 1 year reset clause. So with that it may go up by 20-30 bits, but we can always pass on that with the next borrowing. Therefore, we still will be able to maintain our NIM within this range.
Okay. And sir, on the average ticket size, we are now at 51,000, approximately 51,000. So do you think it will stabilize at these levels or where are we planning to take it to?
So it is not 51,000. Yeah, it's 51,000. That's a small increase on an annual basis. About 9-10% it will go up. There are two reasons. One is the customer vintages keep going on. Two is 20% of our books, which is Madura, which is still at a low leverage, because the base of that was very low when we took over. To that extent, that can still go up a bit. But if you look at if you verificate our portfolio for customer, it's a high in the top 3 states where we have a high vintage customers, which is about 54,000. The entire balance country is only 39,000. Therefore, it's not a worrying fact for us at this point of time. So therefore, maybe more on about 8-10% might go up. But any loan what we give more than 60,000, we give a 3 years loan. Therefore, again, the repayment load on customer also will not change. So it will only further decrease to them. Therefore, we are not seeing any vulnerability here also.
Okay. And what would be our next leg of growth? Would it be expanding into newer geographies or districts or deepening into existing districts? Further, do you think Madura might see a strong growth given the recent court order on Telangana?
Madura will definitely grow faster because it is still at a less productive branches, I would say. Or we have enough headrooms in the Madura branches. Therefore, it will give us a very good growth going forward. But overall, it will be expansion plus deepening. Both will be together. For example, we estimate about 14-15% customer growth, which will fuel the 24-25% portfolio growth, which is both expansion, about 8-10% branch expansion, and the acquisition of customers in the existing branches, which includes Madura's 480 branches, should give us extra headroom. So, but it will be fueled by customer acquisition all across. So, 14-15% customer acquisition will lead to 24-25% portfolio growth. That is what our estimation, Nikhil.
Okay. Last question, sir, from my side. Sir, now that we have already merged Madura with us, and yesterday there were plans or talks that smaller MFIs are still unable to get good rate of funding, and hence there are plans of making or creating a fund for helping these smaller MFIs. Do you plan or see any more inorganic acquisitions in the near future, say in next 1 to 2 years?
So nothing in our plan at this point of time. So actually we don't see any opportunity which is insignificant for our growth, because we have even a smaller MFI acquiring is not an efficient process for us. So therefore we don't see any inorganic growth opportunity at this point of time, because unless it's complementary in terms of the geography, in terms of product, in terms of culture, in terms of size, it won't fit for us. So therefore, we don't have any such plans at this point of time.
Got it. So that's all from my side. I'll come back in the queue and expect to see similar type of quarters from your side. Thank you so much, sir.
Sorry. So maybe we'll add one more point. When we say expansion, for your earlier question, so we still have a lot of opportunity for opening more branches in Gujarat, Rajasthan, UP, Bihar, Jharkhand. That will keep continuing as our normal philosophy of contiguous growth. That will continue, which will add about 8 to 10% of new branches. So that is also one of the key pointer in terms of our expansion.
Perfect. Quite helpful, sir. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. Thanks and congrats on a great set of numbers. Sir, two questions. One on the data side. So this quarter we have seen other OPEX, sort of falling by 10% despite we opening more than 50% branches plus the.
Sorry. Can you just repeat? Suddenly it becomes slow. No, sorry. Renish, we lost you.
Is it better now?
Renish, yes.
No, I think you need to repeat the question fully.
Yeah. Okay. So on the other OPEX side, this quarter we have seen there is a decline in the other OPEX, despite opening more than 50 branches plus the robust disbursement growth. So what is the reason for decline in other OPEX?
So OPEX has come down because of the Q3 it was little high on account of the fundraise, NCD, public NCD we raised. That expenses was part of Q3. Therefore, it is basically a spike in that quarter. It is not reduction in this quarter. I lost you again.
No, sir. I can hear you.
Yeah, you got my point. No, it's not reduction.
Yes.
Basically, the Q3 was little spike because of the public NCD costs have come in.
Okay. So there was a big impact basically.
Correct.
Okay. And sir, last question from my side, a bit on the strategic front. So, as you rightly mentioned that, we are the first MFI to cross 20,000 crore of AUM. So, from a, let's say, 2 to 3 year perspective, do you feel that there is a need for us to, let's say, start venturing into a non-MFI product and build the non-MFI portfolio, or do you feel there is enough headroom for MFI portfolio to grow at 20-25%?
I think, this discussion we had a year back and we already piloted There are lots of pilot going on. The scaling will happen. I think we explained earlier also. So we have piloted many products, and I think couple of are already scaling up. The next financial we are looking at a good momentum there. So I think our view is very clear. Keep following our customers, keep enhancing the product for our matured customers, and again work within the customer segment and ecosystem, and then build the non-microfinance book also. So the idea, I think we already explained earlier also, 4-5 years time, we will have about 10 to 12% of the non-microfinance book. And I think we are clear on that path, and we are working on that anyway.
Okay.
Maybe guys, you want to add a couple of things here? Okay, great. So it is fine. So unless already we have published this earlier also.
Got it, sir. Okay. That's it, sir. And best of luck, sir.
Thank you. Thank you so much.
Thank you. The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Good evening, and thank you for giving me the opportunity. And congrats on a good quarter. So my question was pertaining to yields. So I wanted to understand what is the rate hike that we have taken in the last 6 months, and what is our current yield for the group loan product and for the retail product.
So our overall yield is about 19.7%, right? Sorry, 1 minute. Our current yield overall is about 21.9%, and on the new disbursements, and then the overall is about 19.7% for the quarter. Whereas the retail non-microfinance also by and large same only. There's not too much because some places it is higher than the group portfolio. So since it is insignificant now, it won't make too much difference currently.
Got it, sir. The second question was pertaining to the FOIR. So, what is a FOIR that we have for our existing customers?
So actually, about as the regulation clearly says, FOIR should not be more than 50%. But what we observe that about 70 to 75% of customers, their FOIR is less than 40% currently.
Okay. Got it, sir. Those are the two questions. So thank you so much and good luck for the next.
Thank you so much.
Thank you. We have the next question from the line of Suraj Navandar from Sampada Investments. Please go ahead. Suraj Navandar, the line to you is unmuted. Please go ahead with your question.
Yes, can you hear me, sir?
Yes.
Yeah, we can hear.
Hi, good evening, sir. So my question was on more industry-related question.
So you may need to be little louder, Suraj.
Can you hear me, sir, now?
Yeah, now perfect. Thank you.
So my question was really more of an industry-related question. Other players, even the smaller ones, have given a very strong guidance for the industry. One of the players in their phone call said that industry might grow 5x in 5 years. So my question was, being the industry leader, do you also see such kind of growth coming into the overall microfinance industry? And if yes, then what are the triggers on ground which can lead to such kind of exponential growth in overall sector?
Not really. We don't see. Definitely, our estimation is not that for the industry. We believe that industry also will be within about 20-25% CAGR for next 3-4 years. Beyond that, probably it will further taper down. Actually, that's what our view. So our estimation within that.
Okay, so then we are also planning to grow at around 25%. Aren't we planning to go up higher than industry rate?
We may be at the range actually. So there are two parts of our growth. For microfinance growth, maybe slightly will come down and non-microfinance will kick in. So therefore, together it is 24-25 what we are talking. So therefore, microfinance might come to 22-23 by next year and year after. So and other products will actually take over the space. So overall growth we are talking about 24-25.
Okay, and so what would be our branch expansion plans for this year?
As I said, we normally do between 8 to 10%. Earlier we should do more, but now we actually, because base is quite high, our expansion plan is about 8 to 10 or 12% of our existing branch size.
So around 80 to 100 branches, thereabouts.
No, we are at 1,786 branch currently. 10% is 175 branch.
Sorry. Yeah. Thank you, sir. Those were my questions. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star 1. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity and congratulations on great set of numbers. So I have two questions. One is on, if I look at the presence, so as you rightly mentioned, largely the diversification is now coming by. So if you look at the eastern geography, the presence there has increased for the company, as well as there have been positive signals coming from the northern belt, especially UP. So could you just throw light on the demographics and the positives coming from these two geographies and where the confidence is being reinforced?
See, so I think, demographic expansion, we always go by contiguous districts. Despite, I agree that some states are a little different in terms of economic activity, the growth, the GDP expansion are changing, but we always gain the benefit from going through this process of contiguous district approach, which helps us to understand the district better and then put our employees to work in the next district in a better way, have a better control so that expansion risk and expansion cost is minimized, which helped us. I think despite those kind of spikes, we still believing in going into contiguous spots. So therefore, we already in UP, we will continue to open branches in our bordering district. Similar way, we also in Rajasthan, Gujarat, Bihar, we continue to open that. So we keep actually acquiring that kind of new geography through a district-based approach. With the typical replication of business, we don't see too much difference in terms of repayment or disbursement or acquisition. So which helped us to grow very sustainably in all these areas.
Right, sir. Well understood. So secondly, you did guide on cost income at around 30-35%. So where do you see where do you see the synergies and triggers coming here to maintain this kind of quality number? Because if I look at OPEX to assets, you are one of the lowest in the industry. So how do you see the sustainability here going forward?
So if you look at the last, even because last 5 years, we still sustained within that, right? So I think already we have been with the optimal cost. So it's more of replicating that optimal cost. And now that we have a ability to price based on risk, therefore even the margin is better compared to the earlier regime. So and then the credit risk also have to come down. It's already coming down. We are seeing that happening, and all these things and our own historic quality of operation, sustainability we maintained over a period of time, and very calibrated growth. So all these will help us to manage and keep on improving the overall efficiency, overall financial result. So I think what we talked is from 36% to 35% to 34% kind of thing, which is definitely possible with the economy of operation plus quality.
Noted, sir. So then one last question. What is the scenario on the ground in terms of center meeting attendance?
So we have been witnessing very good improvement over a period of last 6 to 12 months. We had little lesser attendance just after COVID, but by and large we are back into normal. Maybe pre-COVID to post-COVID, the variation is maybe about 5-6% today. So we are quite good in that.
Perfect, sir. Thank you.
Thank you so much.
Thank you. Participants who wish to ask questions may please press star and 1. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening, sir. Many congratulations on strong set of numbers. So, sir, firstly, a clarification. You spoke about 70-75% customers having a PAR of less than 40%. This is incremental, right?
Yeah, it's a new disbursement only, Rajiv. Not
new disbursement, correct.
You are not going back and checking the existing PAR.
Not checking, yeah, correct. Okay.
If you see, largely, we disbursed about 70,000 crores. Huh? Yeah, 70,000, 80,000 crores. So largely, about 60% of the portfolio, 70% of portfolio is it's a new today. So automatically, largely it represents.
Got it. And sir, can you share the average disbursement ticket size, Q4 and Q3?
It is about 37 to 39,000 average ticket size, right?
Average disbursement.
Yeah, disbursement.
About 45,000. Sorry.
And has it gone up significantly Q4 versus Q3? Because I see an 8 to 10% jump across vintages in your portfolio, per borrower.
Yeah, that's a link to vintage. It would have gone up a bit because it's a natural phenomena. As the customer vintage goes up, this will go up. Plus, we also had a good disbursement in Madura, which will actually slowly we are aligning those customers GLP also. So to that extent, if you cover, it might have gone up by about 7-8%, considering these two factors together.
No, sir, actually, I'm looking at CA Grameen's, vintage-wise borrower, average GLP per borrower for CA Grameen vintage-wise. And across vintages, it has grown by 8 to 10% on Q-on-Q basis.
Correct. You're right. That's correct.
So would that be driven by higher incremental ticket sizes in this quarter?
There's a minor change is there in particular the high vintage lines, but it is not a big change in the credit policy. It's not big change in credit policy. So I think if you see YOY, the increase is about 8 to 10% only. The overall GLP per customer. What is increased is that in the Madura book, if you see the slide, where
I can see the sharp.
That's an overall change is there. Correct.
No, I was actually coming from the fact that
18,000 when we started operating with them.
Correct. No. So, sir, actually, I was coming from the fact that now the loan ticket size is more determined by FOIR. So then, do we have a scope for kind of going higher on the ticket size? Because you are also guiding for FY24 that 8 to 10% of the portfolio growth can come from average ticket size increase. That is something we cannot predict, right? Because that will be determined by the borrower's leverage and the FOIR which is available.
No, it is determined by the vintage actually. Your vintage customer also keep increasing by 5 to 10%, right? So automatically to that extent the increase will be there. So because every renewal, if you see, we have 88% customer retention, which means if we renew, that automatically there is a additional limit available to them. Correct. So automatically there will be a little increase. If you see the 10% growth come from renewal and increase, and 15% growth will come from the new customer acquisition. This is what the normal. Even if you see last year also, it's by and large around there. There was a big operation because of write-off and mix. Otherwise, our new customer acquisition almost 20% last year also.
Okay, got it, sir. Best of luck.
Thank you so much.
Thank you. The next question is from the line
of... One more thing, Rajiv, I just wanted to reiterate the point that we would always try and see the adequate money rather than restricted money. Try and see if for the vintage clients sufficiently for their life cycle and as much adequate to them rather than just restricting with the ticket size. So that's only with the vintage clients where they're more than 4 years with us, the risk level are less. There we are actually looking for the adequate funding up.
Thank you.
Yes. Thank you.
The next question is from the line of Sagar Shah from Phillip Capital. Please go ahead.
Good evening, sir. Thank you so much for the opportunity, and first of all, congratulations to the entire team for such great set of numbers actually. So my first question was related actually to our loan book. So in our retail finance portfolio, which comprises of individual loans to two-wheelers, LAP, gold loan, affordable housing, how do you see in the next 2 years scaling up that actually as compared to microfinance? You already explained actually the entire industry is focusing towards growth and there is demand actually on ground. So how do you see the retail finance portfolio as part of CAGL actually growing in the next 2 years, first of all, and in terms of products also?
Right. So hi, this is Ganesh here. So as we guided, right, so we can right now indicate for the next 4 or 5 years. right? So our indication over the next 4-5 years is around 10%. So in that range, probably how we grow over the next 2-3 years will also be based on our experience and scale. So right now we have 82 retail finance branches where we are doing mortgages, which is loan against property, as the primary product. So affordable home loan is something that we will do pilots during this year. So like some products will scale during this year, like your unsecured individual loan for graduated customers, two-wheelers, you will see scale up in loan against property. Affordable home loan will be a pilot. Gold loan is anyway a long pilot for us, and we don't see a large volume coming from it. So overall retail finance majority growth will come from mortgage. It will come from two-wheeler. It will come from graduated customers borrowing unsecured loans from us. I hope I answered it.
Yes, absolutely. So just follow up on that, how are you actually classifying as graduated customers of individual loans from the JLG loans?
So this is basically it's a combination of factors, if I have to put it. So it's a mix of vintage of the customer, it's a mix of credit behavior with us, it's a mix of the customer profile, income earning, capacity to demonstrate cash flow, certain surrogates like multiple income streams, etc.
Okay.
Yeah. So this is
basically whoever sound credit record, those sort of
customers who got stable business, stable income, right? So you will have to look a little more, and hence we've also guided this unsecured loans to graduated customers that even in the long term will be anywhere between 5 to 7% of our overall book. Will not be beyond that.
Okay. Got your point. So I got an idea about how you actually plan to scale up your retail finance book. Now coming on to your portfolio yield actually. Although retail finance obviously offers a lower yield, but obviously it would hardly comprise, if I'm not wrong, as per my estimate, not more than 5 to 6% in the next 2 years on a broader level on a consolidated portfolio. So we are at 19.7% as of now. So in the next 2 years, how do you see your yield shaping up, or maybe are we planning to increase our yield in the microfinance as actually other players are actually offering more yields than you actually. The portfolio yield is even better than you. So basically, how do you see your yield shaping up in the next 2 years?
See, our retail finance book does not dilute our yields. It is in the similar range of microfinance because this is a different segment we are working on, right? So the maximum ticket size is around 20 lakhs when it comes to mortgage. Average ticket size is 5.5, 6 lakhs. So this is the affordable home segment, small ticket LAP. So this is not diluting our returns when it comes to business. Even two-wheeler does not dilute our return. Gold loan, we've already said that, these are short-term in nature. Hence, once we pick up volumes, we can borrow short-term money and hence it will not have a hit on your yield. Again, microfinance, we've guided a NIM of 12 to 12.2%. We should be able to manage that, right? So that's what it looks like.
Yeah, the yield is depend on the pricing. The price goes up, for example, borrowing cost goes up, probably it should go up. The price comes down, it will come down. But what we have to look at is the NIM, which is 12 to 12.2%, which is probably the best in the industry today.
Okay, sure, sir. So basically, I missed that point actually. One of the earlier participants had asked you. Actually, your cost of borrowing is down sequentially. So can you state again the reason actually? We are at around 9.5, and secondly, how do we see? You already told that if the bank raises the MCLR, then we will be at around 20-30 bits higher. So, but any reason for such a sequential decline in cost of borrowing?
It's only decline from marginal cost from Q3 to Q4. Q3, our marginal cost is high because we borrowed high-cost funds and also raised public deposit, that is a public NCD, which was a higher cost for the longer term. Therefore, the marginal cost for Q3 was higher and it's come back to normal again. In the Q4, because we did not raise such high-cost long-term funds in the Q4. That's the only difference, that's all.
Okay. Sure, sir. And now my final question actually is related to microfinance. Microfinance, almost as we have guided for almost about almost 24-25% growth on a broader level. But on ground, even with a higher yield, how is the demand in the rural actually shaping up? Now you're even moving to other states from Karnataka, Maharashtra, and Tamil Nadu. So how do you see demand in the other states? Do you see this demand sustaining in the next 2 to 3 years, or do you do you see that this is just something like a pent up demand sort of after almost a downfall we saw almost for 1-2 years?
For us, it looks it is sustainable at this level, because if you see, even previous year we grow by 23%. Last year we was 22-23. Now we grow by 27%. What your guiding is about 24-25%. Do you believe it is sustainable? And with the increased customer and then the geographic expansion, which will help us to grow, we believe it is possible for 23-24.
Okay. Got your point, sir. Thank you so much, and all the best for it.
Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yes. Most questions have been also answered. Just a couple pending. One is, are our competitors also giving free ticket size?
Sorry, we missed you, Piran. Can you repeat a bit louder?
Yeah. Am I audible now?
Yeah.
So my first question was that are our competitors also giving 3-year loans for higher ticket size products, or the industry is at 2 years and we are unique in this product?
We are not sure actually. We are not sure. We have been doing this since last 2 years actually. So currently our 29% of portfolio is 3 years portfolio.
Okay, fair enough. And so secondly, just I've noticed between 3Q and 4Q, there's a sharp jump in the ticket size in retail finance from like 50,000 to 85-90,000. So am I reading that wrong, or
you're reading right? Our majority of the mortgage pilot kicked off in the Q3 and Q4. Therefore, the average gone up.
So the erstwhile unsecured book, which was with the lower average ticket size, is running down, right? And you are disbursing average ticket size of 5.5 lakhs in retail finance. So the old book is running down and new book is catching up, and hence you will see an increase.
Got it. Okay. That makes sense. Thank you so much and all the best.
Thank you, Piran.
Thank you. The next question is from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, thank you, sir, again. So, two things. First, what would be our outstanding return of portfolio? I mean, if we see bad debt recovery this year, it was 58 crores. Last year, it was 74 crores. So, going forward, what type of outstanding portfolio we have and what type of recovery we are predicting?
So, what with our experience, Nikhil, all these write-offs have been tried hard for 270 days before writing off. So therefore, in our experience, all the recovery, we will recover only 15 or 10 to 15% over 2 to 3 years. See, today we have about close to 2,000 crores write-off book. And so far we already recovered against that about 195 crores. And then this keep increasing. Now that the speed may go up a little bit, but eventually it will stay between 10 to 15 or 18% of recovery in 2 to 3 years time. Because it won't go too much high also.
Okay.
So this is our experience.
Approximately 50 to 100 crores approximate amount will continue to come in every year.
Yeah, you're right.
Okay. So, one more question on competition now. I mean, Bajaj Finance have recently announced foray into MFI. I don't want your commentary on Bajaj Finance, but I want your view on the competition which now has started coming in from the larger NBFCs. These guys have definitely presence into deep rural areas. So your view on competition coming in from there?
Yeah. We expected this competition because after regulator recognized that the mainstream business and made a common rule, so there is a potential that some of them will add this as one more portfolio. But keeping ourselves ahead in competition, the pricing, the process, the quality, efficiency always helps us. Our sense that the potential is so large, we still have close to 10 crore households not touched by or not accessed to microfinance or formal finance. I think there's a huge potential for coexistence everywhere. Many times, the new entrants will start in the urban and then go to rural. But being at the rural already probably have a little upper hand with the potentially better process and better products and better prices will help us. So we expect that some competition will go up. We expect some coexistence will be there in all places. Even now, when we go to rural, our new to credit is still more than 30% even now. So that we believe that will remain for at least next couple of years. And also, the other side is 70% is coming from other MFIs who lend for them and they borrow from us. So in a lower period of time, they'll stay with us only. That also trending. Almost we saw that in 1 year time, 11% customers who borrowed from others joined to us, stayed back with us, but left others. Okay. So I think this is going to be a competitive game going forward slowly.
Sure. Okay, sir. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. The next question is from the line of Aditya Padi from Girik Capital. Please go ahead.
Hello. Yeah, hi sir. A great set of numbers and congratulations to the team. I just had one question on the operational front. I just wanted to understand where do you see, I'm referring to your slide 22. Just wanted to ask that where do you see the borrowers per loan officer going forward in future? Like over a year over year, I have seen like around 4.5% increase versus borrowers per branch have grown by 2%. So is that the math going forward, or do you have like a pegged number, or rather you would invest anything in IT versus the human capital to increase the borrowers per loan officer?
The average numbers that you're seeing in the PPT typically goes up and down depending on the new branches that you open and fresh employees you add. Last 2 years you would also seen a dip because of write-offs, higher write-offs. But a better number for you would be to see in an ideal state, in a state where we are for a certain period of time, a loan officer can reach anywhere between 500 to 550 customers per loan officer. So that is the number we target over a period of time, depending on the life of the branch.
Okay, sure. So that would be like like how many years would you consider for a branch and a branch officer to have that around the 500 number?
3 to 4 years.
3 to 4 years. Okay, perfect. So that's the growth that you see going forward. Say 25, if suppose if you added a branch, in 2021, if you added a branch in 25, that would be ideally that should where it should be ideal.
Yes, absolutely correct. So it's and even otherwise also, we don't look at the productivity from an angle of number of borrowers per loan officer. Other than we don't want them to handle too many. So it's more of how many centers they can handle per day, rather than number of borrowers they handle, because this is always a relationship business. So therefore, there has to be a sufficient space for employee to work. Number of customers need to be lesser rather than very high. So each one of them will handle 5 to 6 centers only per day. So that is the count rather the number of borrowers we watch actually.
Got it. Perfect. Thank you so much.
Thank you. The next question is from the line of Pooja Ahuja from Monarch Network. Please go ahead.
Hi. Congrats on the quarter. Most of my questions have been answered. So just wanted to understand the attrition that we see in our borrowers. If you could provide some more color in terms of where do we see these borrowers moving to maybe other NBFCs or SFBs or banks? Some color on that, sir.
Yeah. I'll give to some extent. I can give the estimates actually, because we do a couple of checks. When we do the dropped out borrower, we keep tracking them for some time, at least for a year, what they're doing. So what we saw is about 60% of dropped customers from us have no borrowing thereafter actually. So they actually winding down from the borrowing. Maybe they don't want to borrow more thereafter, or spouse or somebody started borrowing so that they don't need to borrow. That could be one reason. Other 40% we saw that some of them moving into upper segment like different NBFCs for the higher requirements. That is where our pilot started. Because of this insight, we started this non-MFI products for such customers, so that if they are going to another NBFC, why don't we create that product? So that is a bigger reason for us. So let us follow our customers who not only who are graduating, somebody who is asking the different product than the microfinance, we can address them, whether it is housing or larger business of mortgages or two-wheeler or individual business loan. Everything we are addressing. So it's a part of our research to address this. That's one of the reasons we started non-microfinance business. But frankly, 60% of them we found that they're not borrowing.
Right, sir. So out of this 40%, any ballpark if you could share how many are moving because of higher ticket size, which we can now capture, and how many could be moving to, let's say, other products?
So we have not done that kind of the demand and supply. We only check it from a bureau point of view, because they're no more with us. So what they borrowed, we have the data anyway. So we check with bureau and ascertain this. So I think we are not checked beyond that.
Sure, understood. And lastly, do you see borrowers from any second or third lender to the borrower coming to you?
Yeah, we see that this is happening. One of a strong word of mouth is in favor of us. So we saw, when I say 70% of the ETC is our new customer, there are cases of two lender, three lender also. But we look at our overall borrowing as a criteria. We kept a particular breakup for new customer. Total borrowing from the household should not be more than X to join us. So that's already there. But because we feel that they can enjoy our product sold, then over a period of time, they may be our unique customer eventually. So that's happening. So we see that.
Got it. Yeah, got it. Thank you so much. That's it from my end.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, sir, just one question on the industry. Sir, in your view and as per your knowledge, is the industry following this household level FOIR-based loan eligibility in true spirit? And whether the data availability from the bureaus is clean and complete?
We have not made many analysis so far actually based on the income, and because it's only just last 2 quarters. But maybe some of them are following the true spirit, but it's all very difficult to define. Define because everybody claims that they are following. But right now we don't have clear data. Maybe in 3-4 quarters together, if you start reviewing the entire data of the household, probably will get some sense of some time, because many of them started after October only.
Correct. Yes.
Therefore, it will take some more time to get the full insight of how this is happening.
But the leverage data of the household, that's completely available, right?
Yeah, we have not seen too much variation, but still about 10 to 12% leverage variation we saw when we compared to when we take our income versus when you see the lending. But we will not know the leveraging in the other end, right? Yeah. When they come to us, we have the leverage to that extent, but overall, we don't have full insights at this point of time.
Okay. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, that was our last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. Thank you so much for all of you for hearing us patiently, and look forward for your any queries. You can reach us to our investor desk. Nilesh will take care of any further queries if you have. So thank you so much and have a good day.
Thank you. On behalf of Investec Capital Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.